U.S. small business confidence surged to the highest level in just over 6 years in December, extending the post-election gains. The National Federation of Independent Business said on Tuesday its small business optimism index increased 3.4 points to 105 last month, the highest reading since October of 2018. It was the second straight month that the index pushed past the 51-year average of 98. So the question for us today is, are they right to be optimistic? And we're going to talk to the professor about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and joining us today on Open Interest is my good friend, long-term colleague, co-author of The Options Edge, and Rutgers professor, Mark Guthner. And what some of you may not know, for those of you who are familiar with him, is that Mark actually grew up in Southern California, not that far from the Eaton fire, which is the one that was affecting Altadena. So, Mark, welcome, number one. And number two, before we get down to whether or not we are on the precipice of a recession or some other economic malaise, I wanted to just get your thoughts on what's going on in Southern California. Were areas that you knew and grew up in, were you familiar with these areas? I assume you would be.
Oh, very much so. When I grew up, we were concerned about both fires and earthquakes. And the big Sylmar earthquake hit when I was, 5, 6, 7 years old, very young. And I remember how scary that was. Bridges fell, buildings fell down. That was a big, nasty earthquake. This area is right where I grew up. I grew up in two towns, one called Sierra Madre, which is on the east side of Altadena, where a big area has been devastated. And then later for high school, I would lived in La Cañada, which is on the other side, the west side of Altadena. And as we were talking before the show, that my dad's favorite sandwich shop was in Altadena, a place called Connell's. And they made roast beef sandwiches that he thought were to die for. And he was happy to go take a 45-minute drive to go to a little shack by the side of the road where you just walk up to the window, order a sandwich, jump in your car and move along. So, yeah, I know that area very well, and old stopping ground. JPL, by the way, is not very far from all of this. The Jet Propulsion Lab. I used to ride motorcycles in the wash in front of the JPL facilities, and so I was obviously very concerned. I went and used Google Earth to see if I could see if anything happened to the two homes that I once lived in. I don't know if I think they're okay, because I don't think the fires have gone to those particular parts of the neighborhood. But so fingers crossed that those areas are, sure like this thing to come to an end. I think it's shocking that it's still, how difficult it is to get this fire out, or multiple fires, I guess we would say.
Yeah, obviously they did pretty well, I thought, with the one in the Hollywood Hills, West Hollywood area. That fire sort of conflict rated early on, but they seemed to get that one under control pretty quickly. I think they were putting a lot of resources towards it, and that makes good sense, because if that one had expanded in either or both directions, then essentially you'd have a 10-mile stretch going from basically the eastern part of Los Angeles all the way to the ocean. That would largely be on fire, and there's a lot more houses in that area.
When you think about this, if you think about this, probably by the time it's all said and done, there's probably going to be 20,000 or perhaps more families displaced, and I don't know how you sort of logistically deal with that. I mean, there's so many homes that I don't know. I think we'll have problems with this we'll hear about problems around this for months ahead. And then it'll be very interesting to see if people can get permits easily to clean up the debris and start to rebuild.
Yeah, I was seeing that there was a survey of home builders, and they were being asked about the average time to basically being able to dig ground and start construction on houses in California. And I saw that the range was something in the neighborhood of 30 to 45 months,
Oh my goodness!
which is absolutely shocking. I mean, obviously, you cannot get to a situation where now presumably here we're dealing with rebuilding rather than out and out new constructions.
Yeah,
And I've heard the governor say that they were going to try to do things to expedite, but uh, they're going to have to radically change their process if they want to be able to push things through more quickly. So that's going to be very interesting. And I think also very interesting is the solvency of the California Fair Plan, which is the fire insurance of last resort for insurers. But anyway, as we get more detail on that, because I'm very curious about the financial implications for some of the other insurance companies um, that service California, some that have left, some that have been trying to withdraw, and I'm sure that'll be an interesting topic for another day. But in the meantime, so we got this very good small business confidence number earlier this week.
hmm
We had seen some other consumer confidence numbers relatively recently that were, okay at the very least. So there seemed to be that combined with relatively strong equity prices. But I was curious to get your thoughts on how you think about the health of the economy, where we're going, and I know that you tend to take a look at some data that we don't usually talk about, not that much, at least on CNBC, and I haven't really talked about it that much here either. So I'm curious to get your thoughts on that, and I think you have a couple slides for us.
Yeah, the macro economists that analyze the big picture. What do? They look at employment. They look at um, the inflation rate. Surveys like the ones that you just mentioned. Currencies. They look at a whole host of things. Interest rates, and it can get really confusing about what the state of the economy is. Um, and and so I like to cut through that clutter if you can. And so my number one indicator that I go to when I want to see what the economy is doing is I take a look at what the government's collections of income taxes are, because the presumption here is if income taxes to the federal government are going up faster than the rate of inflation, why businesses are probably growing on a real basis, to make those payments. Yes, these things are impacted by tax policy, which changes continuously, unfortunately, but it does, and that can be a little bit confusing. But when I think about the economy in general, is the economy is going to grow. Why? We have people working hard, creating new productive capacity. Populations are growing, so there's a propensity for the economy to grow if there's not any impediments to people doing what they want to do within the economy. So I don't know if you could put up that first chart, um, and
Um,
it's a little bit
is
back
that
from
that looks like TLT.
that's TLT.
Yeah, we have I think we actually have the federal government current tax receipts, the personal current taxes. I think, um, or perhaps if someone could just share my.
There it is.
Oh yeah.
Okay,
Mm-hmm.
so here's the chart. So you can see that during recessions, um, the tax collections by the government fall. Interestingly, they continued to fall after the recession was supposedly over in 2001, 2002. But then it rebounded and started to grow nicely. We had a big burst of tax collections post COVID. A lot of people had income, so maybe that's a little bit of a a juice number, if you will, because people got money for nothing, really, right? And they got their stimmies just to stay home, and or work from home and things like that. And so that's sort of corrected, come down. It's on the rise once again. So I'm expecting just from this alone that the economies are going to be is going to do okay. It's probably going to grow at 2, maybe 3%. So I'm not looking for anything hot like 4 or 5% that would get everybody worried about Fed interest rate increases and a rebound in inflation. I think we still have an inflation problem, but it's not because of a hot of economy. It's just because of the hangover of lots of money printing that has gone on in the past, 5 years.
Yes. Yeah. So we before we get to the fiscal issue, that question, I think it was a World Bank forecast that I was looking at. So really, there was three or four really big GDP growth numbers I think that we had to think about this week. Um,
Mm-hmm.
First of all, Germany came out and had a second consecutive year of negative GDP growth, which is quite remarkable. It didn't seem like that got as much attention as maybe it should have. China, I think it was yesterday, claimed, and maybe that's an unfair characterization to say claimed, but the number that they reported, I think we sometimes should at least have some degree of skepticism about about numbers coming out of some places. I would include China in that number, but they claimed 5% annualized GDP growth, and I don't
Mm-hmm.
know. One of the things that's interesting about that is that I think you and I were talking about this earlier. That as the yuan declines relative to the dollar,
Right.
and because a lot of contracts on the supply side, so for example, if Huawei and others are supplying Apple, those contracts are typically written in dollars.
Right.
So a a real, in other words, if the Apple contracts don't go up at all from one year to the next, if you're measuring Chinese GDP in yuan and the currency is devalued by, call it, 7%, then presumably in yuan terms, GDP actually is going up, right?
Right. Mm-hmm.
The way they would measure that activity essentially as a larger number in yuan terms. So I don't have all of the methodologies to be able to dissect that as much as I would like, but I thought those were interesting things. The World Bank, I think, was saying that they were forecasting that 2025, 2026 U.S. GDP growth was going to be in the high ones, less than 2%, greater than 1.5% was their forecast. I personally have said and written that I thought the number would be slightly larger. What's your take?
Um, I don't have a strong feeling one way about that. I don't spend that much time looking at the foreign economies, and if you're going to be a good macro person, you have to do that because what's going on in China affects the U.S. What goes on in Germany and Europe affects the U.S. So, um, and I've never really been a macro guy. I've always been about the individual security, and I just kind of look for the big picture to move in our direction. I think the U.S., like I said, is fine. Are we going to see something rip roaring? No. Do I expect a recession? No. I think it's just going to feel a lot like this muddling through kind of situation where employment will do okay. The number of jobs posted might fall a little bit, but still will be plenty of jobs out there for people with the proper skills. So I'm positive, not ebullient, and I'm not negative by any stretch. So That's the world that I'm looking at. I have some other issues that I think are longer term are troubling, and it's something that I talk about with my students a lot, and that is the amount of interest the government pays in debt. So if we could roll to that chart, this one here, notice um, that the more debt we have, the more interest the federal government's going to pay. And even though the amount of government debt went up a lot from 1990, even to date, there was a long period where the interest expense was flat because debt was going up, interest rates were going down, they were kind of offsetting each other, and the government kind of got a freebie to overspend. We now have a bigger problem. So we remember we went down to zero interest rate policy, and interest expense by the federal government was still rather modest, 500-ish $1 billion. But then, the government's average interest rate had something with a two handle on it. That's obviously going up very fast now that we're in a new regime. Same as the old regime. So this reminds me of when I used to trade bonds professionally. That coupons on government debt were 4 to 5 to 6%. Corporates were 5, 6, and 7%. And so we're kind of getting back into where what I think is normal, and so what we should expect for a long period of time. Now, this chart shows that the interest expense the last 12 months was $1.1 trillion. This number is a little bit stale because it's only going through the third quarter of last year. So a more updated number is going to look more like 1.4, and by the end of the year, we're going to have probably an interest expense of 1.6, maybe even as bad as $1.8 trillion. And that's really tragic. I talk about this with my students because they kind of get a raw deal. Because if we take, I don't have a chart for this, but a chart of tax collections of individual income taxes is about $2.8 trillion, running at about that kind of rate. So about half the money people are pouring into the federal government um, is going to pay interest. They're not getting any services for that, and that's kind of a bad thing. And I think that hurts us in areas like infrastructure and things like that, where those are needed to be competitive in the long term. So I'm a little nervous about that. Now, there's a lot of people that are very worried about this so-called debt maturity wall. And who's going to buy this debt that's maturing? And I've heard that scary thing my entire career. That there was various times when there was big chunk of government debt coming due. In this case, there's trillions of dollars coming due. And the answer to that is the people that are getting repaid in bonds. You bought a 5-year bond that's coming due now, and you're a pension fund. What are you going to do? You're going to roll that over and buy another 5-year bond. So I don't see this sort of doomsday scenario people like to talk about on Twitter or X or TikTok or whatever. That look at these kind of things. I don't think that's an issue at all. People get money back; they've got to put it to work, and so people are going to reinvest in government bonds, corporate bonds, etc. And it's just going to be a matter at what rate. And I don't think that's going to be a catalyst for really higher rates. It's simply this incredible demand that the government has to borrow money. Running at a very close to a $2 trillion deficit. You're not supposed to be doing that when the economy is chugging along at 2.5, 3%. You're supposed to be paying down your debt in preparation for the next recession, so that you can borrow money you do a Keynesian stimulus program by spending more money if the economy goes into recession. So this is the reason why I am negative on bonds, is because this is very inflationary. There's no real difference between a government bond and a Federal Reserve note, except for the fact that a Federal Reserve note doesn't pay interest. Both those securities are interchangeable. The Fed goes into the marketplace. It buys a Treasury bond. It issues a federal and it pays for it by issuing a Federal Reserve note, and the money supply goes up. So with the government borrowing $2 trillion, we're still going to see an underlying growth in monetary base and the money supply, and that's going to keep inflation high. So I don't look at all these other things that the typical macroeconomists are looking at it, tax policy, and will the tariffs cause more more inflation? I don't think so. To the extent that a tariff raises prices in the U.S., that is, I think, relatively temporary. So in a year or two, companies move into the U.S. They produce from the U.S. They avoid that tax, and pricing levels kind of come back to normal. So it might throw a little wrinkle into things, but I don't see it as a driver of inflation. I'm an old monetarist that when money grows too fast, you get higher prices.
Yeah, I believe it was Milton Friedman who said that inflation is always and everywhere a monetary problem.
Yeah.
Um, so, a couple other interesting statistics that I saw this week that I wanted to ask you about. Before we move on to, okay, so how do we trade about it? I guess first of all, with respect to who's going to buy the bonds, it's funny because for many years, as rates continued to decline, one of the complaints we heard about that trend was refinancing and reinvestment risk by fixed income investors. That is to say that, oh, that's great. You can buy bonds, of an investment grade that perhaps have a real yield to maturity, annual real yield in the neighborhood of 6 or 7%, and then
Hmm.
rates continue to fall. And then as time goes on, there were discounting assumptions and return assumptions that pensions and trusts might have that became unsustainable because the the rates of return that they could expect to get when they rolled over their investments was substantially lower than the assumptions that these entities had initially made. So in some ways, I suppose that's a positive. Do you think, because of course the buyer of the last resort is going to be the Fed, so they can always drive rates to zero for any bond if they wanted to, simply
Yeah.
by
I just
buying it
buy
at
them
that
all.
level. Do you think we're going to get back to the rates that we saw in the post GFC era, or do you think we are
I
basically settling into a new era of essentially going back to rates that were probably commonplace in the early aughts?
I think the trend in lower rates is over. Rates peaked around 1979, 1980. Treasury bonds, I think, had a 16 handle, perhaps a 17 handle, 30-year bonds, 17%. And then they worked their way all the way down to about, what was the low, about a percent. Um, that trend is over.
Well, the 10 year got down to 60 basis points,
Yeah. And then I
or
forget
there,
where
or even a little
the
lower.
30-year bond, but I think it's close to a percent. And then now I think we're on a long march to higher rates um, uh, uh, in for the next few decades. Um, and so I see this as a like some super long term cycle where we were on the good part with the rates coming down. For our career, certainly my career in the financial markets, I've lived through a time when interest rates only went down. And now I think, as since I like to look at things on a historical basis and go back, decades, centuries, look at other countries. um, that I think that is going to turn around and so we're now on a period of time where rates will probably rise for the next 30 or 40 years, sort of in fits and starts. Not that it's going to go up really fast soon, but rates will go up, they'll come down, they'll go back up, and they'll go back down. But net over time, rates will be higher. And who knows the real reason why? Will there be embargoes? Will there be wars? Will there, what will be the catalyst that drives it higher? I don't know, but I like to think in terms of cycles, and the cycle is on the upside.
Yeah. So we have a couple questions coming in, and we're going to get to those in just a second. But as a follow on to your conversation about the longer term trend in rates, so if in fits and starts rates are going higher, then presumably you're saying number one, the bear market in bonds is not yet over, and higher rates are is not generally thought of as being positive for equities. So maybe we could go through your last couple of slides before we go to asking some folks,
Sure.
you know,
So,
what they have for you.
yeah, this next chart. This is a chart of TLT. That's the ETF that tracks government bonds with a maturity of 20 years or longer, time to maturity of 20 years or longer. So it's the long term interest rates. And you can see this has almost been cut in half. You see the peak there, that little spike at about 160 in early 2020. We saw the bottom a little under 80, so we had close to a 50% decline, and now we're having a little correction that finished. I think that bounced from about 80 to 100. I think the treasury, this ETF is going to work its way down to the lower trend line, and then I think there will be a very nice buying trading opportunity that should last a few years. That you'll probably be able to buy 30-year bonds with a yield of something like a six-ish percentage, six handle on it. So presuming if inflation is around 3% or less, you can actually get a real rate of return after tax, or a real yield after tax. But I wouldn't be surprised that after we trade down to about 60 to 65, that we see a bounce all the way back up to 100 or something like that again. That would, like I said, would last a number of years. But that just means we got to get through a tough period here over the next year. And I think a lot of people are very nervous about the administration and how they're going to handle, the budget issues. Like I said, the deficit is running somewhere between 1.7 and $2 trillion a year. They have plans to do new things, but they also have big plans on cutting expenditures and things like that. So I'm
And
hoping
what
that
about
whatever
the
happens doesn't last too long.
and what of equities? I mean, as we were just saying, if rates, the reason that the S&P rallied late this week was because rates fell.
Mm-hmm.
But with your forecast for rates, it seems like we might want to wonder a little bit about, for example, the S&P. What are your thoughts there? It looks like you have a chart for us.
Yeah, I slapped together a little chart showing a contracting triangle, and when it kind of gets to the apex of that, that's kind of when the process, that bullish process, comes to an end. Are we there now? Yeah, we could be. The first trigger I'm looking for is for the S&P to break that blue upper trend line. I think we're a little above 6,000 today. And so I
Yeah,
think when it
we did
finally
get back above.
breaks, if I'm right about rates and that has the effect on stocks. Now remember, we had that big increase in rates in 2022, right? When interest rates started to rise, the 10-year went from 60 basis points to 4.5. Stocks went down. So I'm kind of expecting the same thing now, and so my first target is I'm looking for the S&P 500 to trade down to about 5,000 Then I'll have to assess on what the world looks like from there. But I think if it were to break the lower trend line, then much lower stock prices could be at hand. That would suggest something is really wrong. I don't know what that wrong could be. That would be require a crystal ball, which I don't have. But nonetheless, I'm just looking at the charts. I'm expecting rates to rise and share prices to fall a little bit. Um,
So, if we're expecting somewhat higher rates, somewhat persistent inflation, then that kind of gets us to a common inflation hedge, which is commodities. Um, what are your thoughts there? We have seen some commodities really take off. I think cocoa was up a lot. There were some
yeah,
issues with cocoa. I think coffee also
coffee is big. Yeah.
is another. So what are your what's your thinking in
So
commodities and
I think commodities have been in a bear market for pretty much all that time that interest rates have been falling. So since the 1980s. And I think and I don't have a chart that can go back that far. This is a commodities index, the Deutsche Bank Commodities Index. I think it is. I think that's what it stands for. Invesco DB Deutsche Bank. And I think it bottomed in 2000. So we had this big rally off that bottom, and then uh, the price of commodities is now consolidating, coming back a little bit. Carter likes to call these a pause that refreshes. And I think when that process is over, commodity prices will be making another move higher. Now, the lower part of this chart shows the same ETF, but I divide it by the CPI. And notice, at least going back to 2008, commodity prices as a basket haven't kept up with inflation. So I'm looking for that catch up trade or that reversion to the mean, if you'd like to um, think about it that way.
hmm, okay. Um,
So, and then another thing that I have is I like to take a look at assets sometimes that have just not done well for a long time. And this is EEM. This is the ETF that tracks emerging market stocks. And notice you can go back to the peak of 2008. This is just before the great financial crisis. And the price of these stocks is basically back at those levels. And this chart is adjusted for dividends that the ETF might pay. So this is pretty dastardly when you think about it. 16, 17, 18 years went by, and investors who bought EEM at that top haven't made any money. And you think about how much money you've made if you were in other assets like even gold and silver, but stocks in particular, U.S. stocks. U.S. stocks has been the big winner over this. Once a bottom was formed in 2010
mhm.
in that arena. So I think as a theme, if you wanted to buy EEM with the idea of having a 10-year time horizon, you're likely to make 10 times your money as the thing moves back to the mean. Um, and then the final chart that I have, if you like to have an individual stock, this is the price action of Vale. Vale is a huge um, mining company based in Brazil. They mine um, uh, coal, iron, precious metals. They do some stuff in the energy spaces, particularly with coal. Um, so they're a very diversified company. They're very big. It's a very sophisticated operation. It's not. This is not a little fly by night um, uh, mining company. The next page that I have here, I show that just to give you an idea of the size of the company, they've got $40 billion of revenue, and they make a couple bucks a share. And if you're looking at a stock of about $8, that's a $4 PE. And the company tends to pay a pretty good sized dividend. I forgot to look, but they tend to pay out a good chunk of their earnings as dividends. Um, I think this is a stock you hold for 10 years, and you'll probably get a compound rate of return of about 25% a year. Um, so some couple of long-term things of buy them for the IRA,
The
and
yield,
don't.
by the way, is like 12% in Volley right now. It's a
Yeah,
massive number.
yeah. What they typically do is they typically do some kind of targeted um, dividend in the middle of the year. They pay dividends twice a year, and then they pay some kind of balancing dividend at the end of the year. So they've made a bunch of money, um, uh, generated lots of cash. They take a capital budget on new mining operations they want to do. Whatever's left over, they just pass out to shareholders. Now, they're also encouraged to do this because the government is a shareholder of the company as well.
So they're relying on that a bit.
So yeah, so the government likes to see a dividend.
Yeah. So
Okay.
with that, perhaps we can take a couple questions if you have time. Steve Garcia is asking us, "Hello, gentlemen. For those who want to begin investing, do you think this is a good time to dollar cost average into major indices or ETFs, such as VTI, SPY, the triple Qs, or should investment be on sectors such as energy, health, and materials?" So why don't you field that question first, and then I'll contribute my 2 cents because I don't want to
Okay. That's fine.
poison the well.
So given that chart that I showed of the S&P 500, I wouldn't want to be dollar cost averaging. I wouldn't want to be buying the major indexes. Um, Also, another sort of danger sign of stocks is the thinness of our markets. I think Carter showed on TV the other day that while the Russell 3000 was up 23%, the median stock was only up something like 2.5 or 3%. So all the returns are going to a very small number of stocks, and that's typically something you see at the end of bull markets. So I would stay away from those, but I am interested. I would dollar cost average in energy. I think the oil and gas sector is very inexpensive. There's a lot of E&P companies that trade at 10 times earnings. Um, the big multinationals, they're making plenty of cash. So that is an area that I would definitely poke into.
So
Materials,
something like
well,
XLE maybe.
yeah, and health. I'm not a know a little bit about health in terms of individual stocks, but I to the extent that you want to be defensive, then health is reasonable for that because we spend money on health whether um, times are good or times are bad. That's not what drives whether or not good times and bad times decide what kind of vacations we go on and what kind of cars we drive, um, but not so much what kind of health care we get for ourselves. So from that, I'll throw it back into your court, Mike.
So yeah, I mean, first of all, I think dollar cost averaging is an investment approach, especially for those who are starting out, that you want to do regard without consideration of market timing in the general case,
Yes.
which
Yes.
is that markets often do very well. It's trite to say it, climbing the wall of worry, but there is no reason why an investor starting out today should not dollar cost average in. That said, I'm likewise with Mark. I'm a little bit concerned about the multiple expansion that we have seen in things like the Nasdaq, the cap-weighted indices in particular, which have had a handful of real outperforming stocks, and consequently, we've seen the valuation multiples go up. So that's going to be the Russell 1000. That's going to be the cap-weighted S&P 500, and that's going to be things like the Nasdaq 100. That said, with respect to healthcare, if you're going to use ETFs, XLV being probably the best known ETF that tracks healthcare, the issue you have there is that those are also cap-weighted. And the largest constituent of XLV is Eli Lilly. Now, Eli Lilly, of course, is in the largest growth area for pharmaceuticals. That is, the pun is partially intentional. We're talking about, of course, the GLP-1s and the obesity drugs. But that has also meant that on the promise of what those things represent, the valuations for many of these businesses has expanded tremendously. But you take a name like United Health, which actually got beaten up a little bit more this week because the earnings, I think, disappointed a little bit. Actually, a part of the disappointment in United Health, which is a company I typically like, Humana also, was their payout. So they had a slightly higher payout. So one of the metrics that a lot of investors in the managed care companies like to look at is for the premiums you receive, how much of that do you end up paying out? And as that payout ratio rises, for a very bad insurer, what would be the worst case? That you completely underestimate the potential expenses associated with the insurance you provide, and you end up paying out more than you collect net of expenses. So it rose a little bit, but I'm not terribly concerned about that. But dollar cost averaging, do it. Maybe look at equal weight S&P, which has a more consistent multiple. I think we talked about that on an earlier live stream. And allocate on a sector basis to the groups that have underperformed most recently, because a big part of that underperformance is that their valuations didn't expand in the way that tech did. So things like XLK. So yeah, it's kind of my 2 cents on that one. So that's, again, with a 2-year time frame. I think that's fine. By the way, for those of you who didn't watch CNBC yesterday, where I caused a little bit of a stir, unfortunately, because I was pushing back on the idea that Apple is a safety trade in a market pullback, something I didn't quite understand. But one of the things I did release was my 2025 acronym. So for those of you who followed, 2024, my acronym was BRAVE, B was for Bitcoin, R was for RMBS, when I was talking about mortgage-backed securities, not the security Rambus. A was for AU, Anglo Gold Ashanti was basically a long gold play. V was for value, as in the S&P Value Index. And actually what bothers me about the Value Index is that it's cap-weighted, and some stocks have landed in it that aren't real values in my view, Apple being a notable example. And E was for emerging markets. Now, Mark is talking about the fact that emerging markets may represent an opportunity. So for 2025, my acronym was RISING. R was for RSP. That's the equal weight S&P 500 ETF, which is trading around 18, just under 19 times forward earnings estimates versus 24-ish for the S&P. And this is with comparable rates of compounded annual growth rates for both the top and the bottom line over the long term. So you're not sacrificing a whole lot in terms of revenue and earnings growth by going to an equal weight. And I really think that a lot of the underperformance that we've seen in equal weight versus cap weight in the S&P 500 has really just been this divergence for the in-favor stocks versus the out-of-favor ones. So that's kind of that. I was for IBIT, which is Bitcoin by another name, the ETF. I'm a Bitcoin bull. Mark, you are too, yes?
I am. I've been a long time bull and still bullish, and will probably be bullish for a long time, unless the market just goes like, everybody kind of loses their mind, which is possible, right?
Yeah, it happens. So SCH, the S was for SCHH. SCHH is this was really a placeholder. It is a REIT ETF. One of the issues that I have with other forms of, so a lot of people want to have a total return investment that's providing them some income, and the dividends on a lot of stocks these days is not that great. So that makes REITs more attractive. That my thinking on the REITs versus other mechanisms for investing in fixed income. So we often talk about a 60-40 bond equity portfolio, equities bonds. My problem is kind of like Mark. I also think that inflation's a tough one to lick. REITs have decent yield, but oftentimes the underpinning assets of a REIT, so they have to distribute for tax reasons most of the money they make. 90% of the taxable income has to be distributed by law for them to maintain their REIT status. But the underpinning assets of a REIT may not necessarily go down the way the principal of a bond would, is my thinking. So if you now that's not always the case. So if you own American Tower, you know the mobile towers, those things actually are depreciating quite a lot actually, and there's real capital investment required to replace them because those things actually, they're technologically out over time as you advance to more modern technologies. But there are others like residential apartments and things like that, where the underpinning assets are probably appreciating with inflation, and that provides some kind of an offset. The next I was for emerging markets, but India specifically, INDA, is the ETF that tracks it. The N was for Nance, as in Nancy Pelosi. So if you're not familiar with this ETF, I think it's quite clever. The folks over at Unusual Whales who track unusual activity, including the investments of all the folks in Congress, and they have a Republican ETF called Cruz, Kruz, and the Democrats in Congress, Nance, Nance, for Nancy Pelosi and Ted Cruz, presumably. But the Democrats have materially their trading is remarkable. They have significantly outperformed the S&P, and they have significantly outperformed the portfolios of Republicans. So for as much time as discretionary trading is permitted in Congress, I think Nance is kind of an interesting play on that. So if you're looking for good money management with they should start a hedge fund, the Democrats in Congress. I guess they have, but they're only investing their own money in it. But you can follow along if you buy Nance, which I think is kind of interesting. And then
by the way, Mike, how long has Nance been around?
Since early 2023. I think it first began trading in February of 2023. I'm going to double check that real quick. When did they release this thing? It first traded. Where's the organizational thing? I was when I was researching it. I remember. So it was in February of 2023 is what I remember. Maybe the first trading day. So they actually, having run an actively managed ETF myself, I can say that sometimes when you go back in time, the data that's available is not. So like the NAV, for example, might not be available back to its inception date. Okay. Yeah, the inception, I'm sorry, was February 7th, 2023. And the total returns for Nance since the inception date, net of dividends, 56.8%.
Holy smokes! Woo-hoo!
How you doing?
I didn't even know
right?
that ETF's out there. So
yeah, that's in less than 2 years. And to put things in perspective, the Republicans, which were out on the same day, their total returns were 31%. So the Nance ETF, the Democrats in Congress, materially outperformed the S&P on a total return basis, and the Republicans materially underperformed. I don't know what that tells us. I'm sure that yeah, well, that's true. So maybe they've been since 2023. I guess the Democrats have sort of been in control. They've been in control of the Senate and the executive branch. I don't know whether that had any kind of an impact, but I'm going to continue to go with the Pelosi outperformance, and so I think that's an interesting one. And then G was for Google. That's the only single name I chose. I feel like the top line growth has been underestimated fairly consistently. So it just occurred to me that over the course of time, I'm always looking at what the consensus is for revenues, and I always wondered why Alphabet traded cheap relative to other peers in the space. Now, there's some legitimate reasons why they would. You could have reducing ad spend on platforms like this one. You could have potential antitrust concerns. There were some of those about Google dominating search, and so that was also a big consideration. And you could think that the secular tailwind of things like cloud and AI might start to slow. But what I've noticed is that as I've looked over the course of years, the growth forecasts for Apple have seemed to be consistently pessimistic relative to what actually happened. And you can own it. It's had better growth than the S&P on the top and the bottom lines, immense free cash flow, and it trades at a discount to the S&P. So, and I feel like they're kind of in a critical area. But, if I'm going to create an acronym at the beginning of this year for you guys to all trade until the end of the year, usually I'm not going to just pick 3 or 4 stocks because I think it's more thematic than that. And I think we've sort of gotten to that. So let's take a look. Next question from Bob. Thoughts on Uber 72 long calls, its post-quarterly earnings release. So actually, on that score, Bob, you didn't say which. Oh, Feb 7th. Oh, okay. So that's relatively short dated. That's well less than a month. So first, I'll throw that one to you first, Mark. What do you think? Uber, 72 calls, stocks trading 67, 65-ish right now. And those go ahead.
So when does it come due? I'm sorry, I missed that.
Is the Feb 7th weekly. I'm actually going to pull it up on
Okay.
Options Play so that people can sort of take a look at this if my screen share is on.
Yeah,
And if this is
that
booting
would
up
be
so we can see what
helpful.
this looks like.
I tend not to be, and we discussed this in our book, The Options Edge. We Mike and I did a fair amount of statistical work, and we were able to show that the best performing options are long dated and in the money, and the worst performing options are out of the money and short dated. So I like to think of this as the lottery effect. Is that I think people are willing to overpay for something. If a fair price is $1.25 for an option and you pay $1.50, it doesn't feel um, very expensive or whatnot. And so we showed that um, if you're going to be a buyer of options, you want to have them in the money and longer dated, and trade out of them before they come to expiration, typically a few months before. Um, and if you want to be a yield investor, if you will, and sell options, we showed that you're better off selling options that are out of the money and relatively short dated. So into February, that's pretty short dated, and you're out of the money. So if I was to play this to the long side, that's not necessarily how I would want to do it. I think I would guess the probability of profit is pretty low on this, and I see it looks
Yeah,
like
so
pretty
the probability of profit's 21% on that.
yeah. So that's why I say the options that are short dated, not on money, they're very inexpensive. You can buy them for $1, 50 cents, whatever, um, and you make a bundle if it goes in your way, just like playing the lottery. So that's typically not what we do, and it's typically not how we structure sample trades over at the Options Edge.
So, yeah, I just wanted to offer a quick compare and contrast on that. And so here we have an in-the-money March call spread, which I was looking at the 65.75 $10 call spread, cost you $4. That's more than $2.50 in the money. So you're now. Why did I pick that? It's because the amount of decay that you would pay to have this March call spread is, and this is still has decay, so it's the probability of profit slightly less than 50-50. But also the payoff is slightly better than 50-50 as well. But observe the following. So the extrinsic premium of these two trades is pretty close to the same. So $1.50 a share if you buy those Feb 72 calls. And the March 65.75 call spread, you're spending $4.06, but 2.5 bucks of that is in the money. So you're really spending about $1.50 out of the money. So both have comparable extrinsic amounts of premium. So that's how much decay. But the decay in the March call spread is for a trade that expires in over 60 days and in February less than 30. The break even for the call spread is 69. The break even for the outright is 73 and a half. So to Mark's point, so you need 6.5% better upside in a shorter time to just buy that Feb outright than you would to buy the call spread. Now you're capping your gains by buying the call spread. So, but if you want a higher probability of success, one of the other things I will also say is that some of these trades tend to shake people out. If you're always trading something really short term rather than sort of having a strong underpinning thesis and letting it play out over a little bit of time, sometimes you get shaken out. I do too. I will tell you that sometimes I'm like, oh, you know what? I think this thing could bounce off of earnings or this or that, and then if it doesn't start to happen immediately, I'm just I'll dismiss that. It's kind of a bad habit. Sometimes we can't help ourselves though. So that is that. So FinWest, who I believe is joining us from overseas. And actually now we're sort of going all the way around the world because Mark is, it looks like you're in your office at the university right now, right?
I am. I am getting ready for classes which start next week. So plenty
okay.
to
So
do.
we don't have any, so no students are knocking on your door yet for office hours?
Not yet. That'll start. That'll start next week. I'm working a lot right now on a class on digital assets. So a
Okay.
lot of work to be done there, and I think I got a full class. The class filled, and so I'm anxious to start teaching some things that are a little bit different than the traditional investment analysis and portfolio theory and fixed income valuation and stock valuation and managing interest rate risks and all that those kind of things that that I normally
FinWest
teach.
is joining. Yeah, FinWest is joining us today from Bangkok, and
Nice.
you worked as an investment banker in Asia for a while, didn't you?
I worked as an investment consultant, or I'm more like a management consultant in Indonesia for a number of years. I helped the country's largest life insurance develop investment processes to improve their portfolio returns. And then we got into asset liability management and insurance product design and things like that. And then after that, I went to work for the ANZ Bank, Australia New Zealand Bank, and we did wrote a lot of loans in Southeast Asia for sure. Every other places too, Middle East, Latin America, but a lot in Asia. I really enjoyed the work and the people and the food when I was working over there.
Mm. Well, I think we have, at this point, chewed up the hour that we usually dedicate to these videos. For those of you, so this was not a regularly scheduled one. Important reason to hit the notification bell, just so that you're aware when we do these. But, Mark, are you going to be available to do this more regularly on Fridays so that we might be able to do sort of a midday thing like this with some regularity?
Yes, I think so. My classes are all on Monday to Thursday, so my day is open on Friday. Although you might hear some kids bang on the door as they
Demanding a
want
better test
in.
score?
Yes, as we want to get on this video here. So
Well,
yeah,
I'd like to have
yeah,
them on
lots
the
of.
video, but I don't want to. I don't know that we can deal with a public forum for them to try to get their grades up.
All right, yep. No, we can do that for sure.
Well, I really look forward to that. Okay, so for all of you who joined us, our hope and expectation, Mark and mine, is that we're going to be able to do this more regularly. And I realize that these sort of have a more academic flavor to them, but I think there's some value in that, and I hope you guys agree. So thank you all for tuning in, and Mark, thanks for joining me today. I'm looking forward to the next one.
Okay. Thank you, Mike. Have a good weekend.
See you all on Monday.